Hi, my name is Maurizio Badalico and I'm a senior financial analyst with the City of Eugene. Today I'll be providing an overview of Oregon's property tax system. Here are the topics I'll be covering. We'll start out with a few property tax basics and a brief overview of the system prior to 1990. We'll then get into Measures 5 and 50, which drastically changed the system and introduced the limits that are contributing to the financial distress experienced today by local governments around the state. We'll also look at some Eugene property tax data and trends, and finish up with a quick summary of the increasing costs of providing local government services. Let's start with a few basics about the property tax system. Property taxes are governed by the Oregon Constitution and state statutes. Therefore, property tax reform would require action by the state legislature and a vote of the people to amend the state constitution. The county handles property tax administration, including appraising most taxable property and assessing and collecting taxes due. Certain large industrial properties are appraised by the Oregon Department of Revenue. DOR also appraises certain transportation, communication, and energy utility properties through a program called Central Assessment. Taxable property includes all privately owned real property, such as land, structures, and other improvements. For businesses, taxable property also includes the personal property of the business, including machinery, equipment, and other furnishings. Oregon law allows many types of taxable property exemptions, and we'll take a closer look at some of those later. Before Measures 5 and 50, Oregon had a levy-based property tax system, which means that a taxing district's levy was submitted to the county as a dollar amount. Each taxing district calculated its own tax levy based on its budget needs. Generally speaking, the full market value of property was taxable. There was no separate definition of assessed value. The levy for each taxing district was then divided by the total real market value in the district to arrive at a district tax rate. Most levies were limited to annual growth of 6% without voter approval, but levy increases of more than 6% could be achieved with local voter approval. Measure 5 was passed by Oregon voters in 1990. Measure 5 retained the levy-based system but added rate-based limits on taxes paid by individual properties. These limits are $5 per $1,000 of real market value for education taxes and $10 per $1,000 for general government taxes. These limits apply to operating taxes, but not bonded debt levies. If either the education or general government taxes exceed the limit, then each corresponding taxing district has its tax rate reduced proportionally until the tax limit is reached. This reduction in taxes is called compression and results in millions of dollars of lost revenue for schools and local governments each year. Later in the presentation, we'll take a closer look at how compression works. Another impact of Measure 5 is that it shifted more K-12 education funding to the state. Local property taxes used to make up about 2/3 of K-12 funding on average before Measure 5, but that ratio dropped to just 1/3 after Measure 5, with the state making up the difference. Measure 50 was passed by Oregon voters in 1997 and transformed the system from levy-based to primarily rate-based. Each district's permanent tax rate provides critical operating revenue for general fund services. Today's permanent rates are essentially a reduced version of whatever tax levies existed locally when Measure 50 was passed. This cut effective tax rates by an average of 11% statewide from pre-Measure 50 levels. Permanent tax rates cannot be changed by any action of the district or its voters and remain as they were set in 1997 with a wide variation across similar jurisdictions. Measure 50 also separated property taxes from real market value, and instead taxation became based on a newly created assessed value. For existing properties at the time, assessed value was established by reducing the real market value by 10%. For new construction after that point, the assessed value is determined by the change property ratio, which we'll discuss in more detail later. After the initial assessed value of a property is set, Measure 50 limits the growth of that assessed value to just 3% per year. Measure 50 also stipulates that assessed value may not exceed real market value. As a result, if the real market value of a property ever falls below its assessed value, the taxable value will be set at the lower real market value. Measure 50 also created a new type of levy known as a local option levy. Local option levies can be passed by voters to temporarily raise revenue beyond the permanent rate amounts. Because voters at the local level must approve these levies, they represent one aspect of local control over property tax revenue. Local option levies are restricted to 5 years for operations or 10 years for capital projects. These time limitations provide short-term remedies rather than long-term solutions. Due to their temporary nature, local option levies come with budgetary and service uncertainty, and operating levies must be renewed by voters every 5 years to maintain desired services. Local option levies can be approved either in rate or dollar terms, and are the first to be compressed if Measure 5 limitations are exceeded. The implementation of Measure 50 has also resulted in inequities in the current system, and here is just one example. These two homes sold around the same time for similar prices, but you can see they have very different assessed values and tax bills. It all depends on when a property's initial assessed value was set and the local market trends where a property is located. This example happens to be residential property from Portland, but these types of inequities can and do occur across all property types across the state. This chart shows statewide real market value and assessed value trends for the past few decades. The solid blue line represents real market value, while the dashed orange line represents assessed value. You can see that assessed value began in 1997 after passage of Measure 50. The current market trend is captured in the blue line, but property tax revenue is limited by the lower orange line, which reflects the 3% assessed value growth limit plus new construction. The Lincoln Institute of Land Policy is a nonprofit research foundation. One of their research focus areas includes efficient and equitable tax systems, and their website contains a comprehensive database of property tax data across all 50 states. This is what they have to say about Oregon's property tax system. One effect of Measures 5 and 50 was making Oregon's property tax system one of the most complex in the United States. Although several other states use assessment limits, Oregon is the only state where assessed values do not reset to market value each time a property is sold. This publication was written by two of Lincoln Institute's researchers, drawing lessons from 30 years of experience with property tax assessment limits. This is what they have to say about Oregon's unique detachment from real market value. Oregon does not adjust assessments upon change in ownership, nor does it assess new construction or improvements at market value. With no periodic recalibration of assessed value to market levels, the Oregon system has gone the furthest of any in breaking the link between property taxes and property values. At this point, we'll transition to Eugene property tax data and trends, and see how Measures 5 and 50 impact local property tax revenue. Let's start with a breakdown of property tax revenues received by the City of Eugene and the Urban Renewal Agency. This chart shows the various funds that receive property tax revenue. The general fund receives the largest share at 82%. The second largest share goes to the General Obligation Debt Service Fund, which is used to pay the debt service on voter-approved general obligation bonds. The city also has two funds for voter-approved local option levies, one fund for Parks and Recreation and another for library services. The final slice of the property tax pie goes to the Urban Renewal Agency, which operates the downtown and riverfront districts. The chart on the right takes a closer look at general fund revenue sources. Property taxes, EWEB contributions in lieu of taxes, or SILT, and service charges are the top three revenue types in the general fund. These three revenue types account for 85% of general fund revenues, with property taxes representing the largest share by far at 71%. The other category is a mix of smaller revenues such as right-of-way fees, marijuana taxes, and state shared revenues, among others. This table provides additional details about the various property tax levies for the City of Eugene and Urban Renewal Agency. Starting at the top, the first row shows the permanent rate levy, and this is the only levy that goes to the general fund. Eugene's permanent rate has been frozen at about $7 per $1,000 of assessed value since 1997 and cannot be increased. This rate is slightly reduced due to Urban Renewal Division of Tax calculations. We don't have time to dive into that process today, but there is more information in our adopted budget document if you're interested to learn more. The next two rows show our local option levies. These levies must be renewed every 5 years, and you can see the duration of the current levy in the far right-hand column. The next row shows our bonded debt levy. Voter-approved general obligation bonds are typically long-term bonds paid off over many years, but one exception is our street repair bonds, which are on a 5-year renewal cycle similar to the local option levies. And the bottom two rows show the levies for Eugene's urban renewal districts. When Eugene taxpayers pay their property tax bills, that revenue provides funding for more than just the city of Eugene. Here is the current breakdown of each property tax dollar paid by the majority of Eugene taxpayers. Starting at the bottom, school districts receive the largest share at 47 cents. This includes K-12 school districts, Lane Education Service District, and Lane Community College. Moving up the dollar sign, 41 cents goes to the city of Eugene, 10 cents goes to Lane County, and 2 cents goes to Eugene's Urban Renewal Agency. If we break down Eugene's 41-cent share, the majority supports the general fund, while the remainder provides funding for voter-approved bonds and local option levies. This table shows City of Eugene and Urban Renewal Agency taxes for a typical Eugene home. This is defined as the median assessed value of a single-family home, which is currently about $254,000. The tax bill for City of Eugene and Urban Renewal Agency taxes for a typical Eugene home is a little over $2,100. Earlier I mentioned the Measure 5 rate limits and the concept of compression. Over the next few slides, we'll review how the limits are applied and how compression works. This table is from the Lane County Tax Assessor's Office and shows the rates that make up the tax bill for the majority of Eugene taxpayers. For reference, City of Eugene levies are highlighted in blue, and Urban Renewal Agency levies are highlighted in purple. I know there are a lot of numbers on this slide, but I'd like to draw your attention to the total tax rate for each category. The total tax rate for education exceeds the Measure 5 limit of $5 per $1,000 of real market value, so these schools are losing revenue to compression. The total general government tax rate is under the Measure 5 limit of $10, but it is getting closer with each new local option levy added. We are currently just 34 cents away from starting to experience compression losses. And the final category is bonded debt, which is not subject to compression limits. Compression is computed on a per property basis. When a property's assessed taxes exceed the limit, the tax obligation is reduced or compressed to the Measure 5 limit. Local option levies are compressed first, followed by permanent rate levies. Each corresponding taxing district has its tax rate reduced proportionally until the tax limit is reached. The amount compressed is lost revenue for the districts. Let's walk through a simplified example of how compression works using the education tax rate from the previous slide. In this example, the real market value of a property is $400,000. The education Measure 5 rate limit is $5, which equates to $2,000 of taxes. This same property has an assessed value of $300,000, and the actual education tax rate that we saw in the previous slide is almost $7. The education taxes it would have paid without the Measure 5 limit is $2,083. This taxpayer ends up being assessed the maximum of $2,000, and the extra $83 is lost to compression. The primary impact of compression is revenue loss for schools and local governments, but there are other related impacts to consider. Compression essentially creates competition amongst taxing jurisdictions within the same category, and the actions of one jurisdiction can negatively impact the revenue of another. New local option levies, new special districts, and even urban renewal districts can impact compression. Here in Eugene, we do not experience general government compression, but we are getting closer to the Measure 5 limit, and the potential for compression is certainly taken into consideration anytime we analyze new funding options. Another phenomenon caused by compression is that voters may vote in favor of tax increases they unknowingly won't have to pay for because their property exceeds the Measure 5 limit. In the case of a new or increased levy, properties that are under the Measure 5 limit and not experiencing compression will bear the burden of paying for it. This has happened up in Multnomah County, where Portland voters approve countywide measures even though many of their properties don't pay extra due to compression, while surrounding cities like Gresham end up paying the full amount even if the measure was not supported within their city limits. This chart shows statewide revenue losses due to compression over the last 25 years. The amount can be substantial, peaking at more than $200 million in fiscal year 14 and exceeding $150 million in the most recent year available. The amount of compression that occurs in any given year depends on how much the tax rates exceed Measure 5 limits and also how much of a difference there is between real market value and assessed value. Oregon law allows many types of taxable property exemptions, and this is a summarized list for Eugene. Over $4.6 billion of assessed value is currently exempted from property taxes, which is almost 20% of the assessed value citywide. Some of these exemptions are locally controlled, and these are indicated by the blue stars. However, the majority of exemptions are mandated by state statutes. In a theoretical world, if all of this property was taxable, it would generate nearly $31 million of permanent tax rate revenue per year for the general fund. The first row of this table includes the University of Oregon, which is Eugene's largest individual exempt entity. Their expansive campus and prominent sporting venues include Hayward Field, Matthew Knight Arena, and Autzen Stadium cover more than 400 acres. The University of Oregon alone accounts for $1.6 billion of exempt assessed value, which, if taxable, would generate $10.6 million per year for Eugene's general fund. This chart shows the city's growth and taxable assessed value over the last 20 years. This metric is important because the general fund's permanent tax rate has been fixed at the same level since 1997. Therefore, growth in general fund property tax revenue comes from growth in taxable assessed value, which is limited to 3% per year plus new taxable construction. This chart is divided into three sections, starting with before the Great Recession on the left, during the recession in the middle, and post-recession on the right. The post-recession average growth has remained below pre-recession levels. On the far right-hand side, you will see that the most recent growth rate came in at 3.8%. However, the current growth rate would have been just 3.4% without the agency board-approved frozen base increase. This action shifted taxable assessed value from the Riverfront Urban Renewal District to the overlapping taxing districts. The average annual growth in taxable assessed value over the last 5 years has been 3.8%. Another key driver of property tax revenue is the collection rate. The city does not receive 100% of taxes levied for two primary reasons. First, the majority of taxpayers take advantage of an early payment discount of up to 3%. Second, not everyone pays their taxes on time, and thus taxes owed become past due. The average collection rate over the last 5 years has been 95.6%. One contributing factor towards lower assessed value growth is the declining change property ratio over the last decade. Introduced by Measure 50, the change property ratio is a countywide average of assessed value to real market value for properties within the same classification. This chart shows the change property ratio trends in Lane County for the most common property types, including residential, commercial, industrial, and multifamily housing. The ratios are generally trending down because real market values have been growing faster than assessed values. The change property ratio is important because it's used to determine the assessed value of new construction for the first year on the tax roll. After that, assessed value growth is limited to 3% per year. Another key point is that lower change property ratios mean that it now takes more new construction value to generate the same amount of tax revenue. This is how much new construction value it took in fiscal year 14 to generate $1 million of general fund property tax revenue in Eugene. Fast forward to today, and it takes significantly more new construction value to generate the same $1 million of tax revenue. Here are a couple of recent examples here in Eugene that illustrate the limitations caused by the change property ratio. These are both new student housing apartment complexes that joined the tax roll in fiscal year 24. They have similar real market values near $90 million, but the initial assessed values are about $36 million after applying the multifamily change property ratio of 0.4. Said another way, local taxing districts will receive property tax revenue based on 40% of the units in these buildings, but will provide services to all units. The change property ratio was intended to be an equitable way to add new properties to the tax rolls compared to existing properties. However, the result is that new growth doesn't pay for government services that the residents who are moving in want, exacerbating local government's deteriorating ability to maintain service levels. Here is a look at our top 10 taxpayers in the current year compared to last year. I won't go through the whole list, but I will point out the most significant year-over-year changes. Shepherd Investment Group, a real estate investment company, moved up to second place after acquiring additional existing rental property. Valley River Center dropped to third place after appealing their values. It's also worth noting that the utilities and telecommunication companies on this list are centrally assessed by the state of Oregon and do not follow typical growth patterns. Central assessment can result in volatile changes in assessed value from year to year. The overall assessed value for this group of top 10 taxpayers increased by just 0.4% from the prior year. Here we'll look at the taxable assessed value that would have been needed to fill the $11.5 million general fund budget gap that was addressed during the 2025 to 2027 biennial budget process. As you will see, the current property tax system makes it a difficult proposition to close this gap with property tax revenue. In order to close an $11.5 million budget gap, an additional $1.7 billion of taxable assessed value would be needed. This is about 9% of Eugene's current taxable base. This amount represents assessed value, which means that significantly more real market value would be needed when considering the change property ratio. Here are some examples of how much new construction it would take to generate $1.7 billion of taxable assessed value. These estimates are intended to provide a rough sense of the magnitude needed to close the budget gap with property tax revenue under the current system. It's important to note these estimates do not consider the increased expenditures that would also be necessary to provide general fund services to a larger population. The limitations of the property tax system result in revenues not keeping up with expenditure growth. There are many factors that add upward pressure on the cost of providing local government services, and a few examples are shown here. Inflation has been high in recent years, putting upward pressure on the cost of materials, supplies, and wages. Other personnel costs, such as PERS, continue their upward trajectory, and Eugene has experienced many consecutive significant biennial PERS rate increases. There are also unfunded state mandates such as Paid Leave Oregon and more recently legislation passed during the 2024 session that creates additional costs for PERS employers. Aside from the challenges of maintaining existing service levels, local governments are also facing evolving service needs such as homelessness, affordable housing, climate-related expenditures, and service expansion for a growing community. The result of this imbalance between revenues and expenditures is that staffing levels are not keeping up with population growth. Eugene's citywide FTE per 1,000 population was 11 back in 1996 before Measure 50, and it's just 9.4 today. Eugene's population has grown by 55,000 residents since 1996, so in order to achieve the same FTE ratio as we had back then, Eugene would need to add another 265 employees to our current citywide footprint. Over time, the limitations of Measures 5 and 50 have contributed to a general fund structural imbalance where revenue growth has not kept pace with expenses. This issue is not unique to Eugene and affects local governments around the state, many of which have implemented alternative revenue sources to mitigate service reductions. Looking to the future, the League of Oregon Cities launched an effort in 2024 that includes focus groups and public opinion surveys around the state to better understand how Oregon residents feel about the property tax system and possible reform strategies. And in 2025, the Oregon legislature passed House Bill 2321. This bill directs the Legislative Fiscal Office to analyze and prepare a report on the current state property tax system and options to modernize the property tax system by December 1st, 2026. These efforts have the potential to lead to at least some degree of property tax reform down the road. Thanks for joining me today to learn about Oregon's property tax system.